Welcome. This is going to be an introduction to secrets of venture and angel investing. I'm Kamal. I'm one of the co-founders of Loyal VC and one of the people behind the launch of this venture fund. But it's really based on years of experience as an entrepreneur, years of angel investing. So really, this is a chance to share with you some of the things that I've learned the hard way through my angel and venture career, and hopefully give you a chance to benefit from some of those. Uh, uh, Give you a chance to benefit from some of the things that I've learned the hard way. So let's kick things off here. First of all, look, my background, I've been an entrepreneur for 20 years, 15 years, that angel investing. I was really confident when I jumped in to my early angel investing. My undergrad was in engineering physics, top of my class, INSEAD MBA, been a management consultant for Bain and Company, and I made money in my first time out as an entrepreneur. And when you sort of have a background like that, you tend to think very highly of yourself and your ability to make money. And I knew what the stats were in the industry. I mean, everyone always said the stats, and I said, yeah, that's the stats for everybody else. I'm different. I'm going to do better. And the results I got were exactly industry average stats. So for my first 10 investments, 7 of them failed completely. 2 of them, I got a little bit more than my money back. One investment out of the 10, I got 30 times my money back. Took me 14 years to get there, so it was a long way to get there. So yeah, I made money overall in my portfolio, but that one investment was not the one I thought would succeed. I made 10 investments. I did not expect 7 of them to fail. So there was really sort of an eye-opening moment for me. And let me just sort of take you through and share some of the things about the industry. And like I said, I thought the industry stats didn't apply to me, and I learned the hard way that maybe they do. Um, Before we jump in, I mean, the question is, why should you either be an angel or invest in venture? And this is just a sort of history of top tech companies and when they went public, and how much money they made after they went public for the people who invested in them when they first listed. So you can see decades ago, it was really smart. You didn't need to, if you wanted to invest in Microsoft or Amazon, you just need to wait till they came on the public markets, invest in them then, and you could make a lot of money. That has changed with a lot of large private funds, late stage venture funds, private equity, etc., jumping into companies and buying them up before they go public, such that, I mean, you can see Google was, you could have 40 times your money. Facebook, you could only have made 7 times your money. And recent ones like Uber, you make hardly any money at all in the public markets. So if you believe in tech, if you believe in getting the growth of tech companies, it's become harder and harder to access those returns in the public markets, and you really need to be in the private markets. Now, you can invest directly as an angel. You can invest in venture capital funds. In some cases, some of those things will be accessed by private equity funds. SPACs were a way to try to bring the public market into it. Hasn't really worked as people planned. Another reason to think about investing in private companies is they are the engine of the economy. Now, everybody knows, I'm sure, that over 99% of companies are private, but the public companies are a lot bigger. And most people think about the public companies as dominating the economy. If you actually look at sales generated in the US from public versus private companies, 57% of total sales come from private companies. All these monstrous public companies that you know the names of actually are less than half of the economy. And that's why you see all these headlines all the time, which says small business is the engine of economic growth in the US, the UK, whatever country you pick. Well, of course, it's the engine of economic growth. It's more than half the economy. Um, this is another chart which we pulled together with rough data to try to say, how is human wealth distributed? And if you think about investing your personal money, you probably want to think about investing it to match global wealth. Now, everybody knows about investing in bonds and in public equities, shares, the stock market. That makes up about 40% of human wealth. Many people also do invest in real estate, and real estate is another 30% or so of human wealth. But the next biggest sector of wealth for humanity as a whole is private equity, and that's about 16% of the economy. And then there's things like infrastructure, et cetera, to look at. So if you think about saying, what does a market neutral investment portfolio look like? A market neutral investment portfolio probably has about 16% private equity and 24% or so of these different alternative investments. And in fact, we can see that right here. If you look at the activities of professional investors allocate somewhere around 24-ish% or so of their assets to alternatives, of which private equity and venture capital is a subset, as is angel. But they allocate about 24% to the asset class. And you can see professional investors are really well penetrated into alternatives, private markets generally. The ones who really make a living off of it, like endowments and foundations, put a lot of money into the space, and some insurance companies, et cetera, do left. But as a general rule, we're talking about an 18-ish, 20-ish% allocation to this asset class, which is very different from what you see with individuals. So when you're thinking about your own money, I mean, there's a reason professional investors put a lot of money into this space. And if you are one of this sort of top half of individuals managing your private wealth, and you don't have a 20% allocation to alternatives, you may want to start thinking about what you're doing to get into the space. Look, you should never think to time the market, because timing the market is really hard and you'll often get it wrong. It is, however, interesting to note, if you're thinking about getting into this space, that now seems to be an especially good time to get into it. If you look at where the stock market is right now, and in fact, the S&P 500 has been on a tear in the past few months, stock markets are at a record high right now. And then I have the Cambridge Associates US VC Index. This is what they call institutional grade venture capital. The green line is their own returns. But you can see that venture capital seems to be at a cyclical low right now, whereas the stock markets are approaching record highs. So this may be an interesting time to think about having some of your money allocated into private markets. Now, of course, there's a whole bunch of things to think about when you think about investing in venture and angel, if you think this is a good time. So let's start to get into them. The first thing to keep in mind is that if you're going to do it yourself, angel investing is fundamentally very simple. All it is it's trading. The goal is you buy a basket of assets low, you sell them higher. And as we mentioned, now is a pretty good time to get into the space, whether it's as an angel or in venture, because valuations have been driven down for a whole bunch of reasons. And with those valuations coming down, look, good companies are not being funded. It's a good time to be able to put more money in at good valuations. You can buy low. I started the talk by talking about the humility that I learned around investing in this space. I'm not the only person. There's very smart VCs out there, much more experience with much more decades behind them than I have myself. So for instance, Bessemer Venture Partners, probably the oldest VC in the US, they have on their website their anti-portfolio. And if you're thinking of doing any direct investing, you're not looking to invest in a venture fund, but you actually want to invest your own money, you should really go and take a look at that anti-portfolio. It lists a selection of companies that Bessemer said no to and why. Apple, Google, Zoom, Facebook, Tesla, PayPal. And I mean, the reasons they had were very good reasons. I mean, they talked to the founder, one of the founders of Facebook. They said, hey, kid, have you never heard of Friendster? Move on. It's over. Or PayPal, rookie team, regulatory nightmare. Forget it. So a lot of this sort of really, really smart people doing really, really smart analyses have struggled to actually identify the top companies, and they've said no to companies like Google and Apple because it wasn't obvious to them at the time, and perhaps not obvious to anyone at the time what those companies were going to do. Look, industry-wide, if you just look at our results, and this is stats from the venture industry. So this is from generally highly experienced venture partners, because these are the ones who've been funded to get their funds by a whole bunch of institutional investors who are very careful about selecting only funds they think will be top quartile. And if you look at just industry-wide, and this data is from about 6 or 7 years ago, I believe, how all the deals turned out, 65% of the deals failed to return the capital invested. And the next 31% together return around 3 times your money. So if you run the math here, you end up with getting 1x your money back again from 96% of your investments. And yeah, it sounds wonderful, get 3 times your money back in a deal, you get 3 times your money back, but when 2 deals fail for every one that succeeds, that leaves you flat. People make money in this industry because of the home runs. All your profit comes from the top 4% of your deals. And depending how many of which kind you have, you can end up with very good returns or decent returns. But this is industry-wide what's going on. We're all trying to pick home runs. We get it right 4% of the time. And that really leads to asking a fundamental philosophical question, which is, what type of activity is angel or venture investing? Is this like cooking, where you follow a recipe? You've got a 2 times founder in a space with a big market opportunity, with a tech co-founder with experience at a big tech firm, etc. Is there a formula you can follow to get predictable outcomes? Or is this perhaps more like poker? And in poker, you can start off with a hand which looks like an amazing hand, and it can turn out, based on how things evolve, to be the worst hand, and things that looked really bad or still interesting could turn out to be better. So that is really one of the things to think about. And it's no secret, we look at the data, we sit here and we say, maybe this is activity is more like poker where things are unpredictable. And if so, then the question, of course, is how you should invest. Because look, if this is an activity where you can predict the future, then you should minimize false positives. You should say, I can predict the future. I can predict who's going to lose money. So therefore, I should look at all these companies, figure out which ones are going to lose money and which ones are likely to win. And because I know and I can predict this, I should invest accordingly. This is the traditional angel view. Angels pick 1 in 50 deals. It's a traditional venture capitalist view. Venture capitalists pick 1 in 200 deals. Because this minimize false positives is the approach to take when you can predict the future. But if you can't predict the future, if there is randomness to this, then when you start to run the numbers, and this is data from Abe Ottman of AngelList, he was one Kaufman Fellow as well in 2019, he said, look, if you are worried, if this is an unpredictable industry where it's impossible to recognize Facebook at the moment you see it as the next Facebook, then what you should do actually is they ran the data and they said seed stage investors should invest in every credible deal. And they said over a 10-year investment window, funding everything beats 90 to 95% of investors picking deals. And they said that's even if you have some alpha, even if you're good at picking deals, you're still going to underperform people who do a large number of investments. What this data tells us is you should be putting smaller amounts of money into a lot more deals. So if you're investing as an angel, don't write big checks, write fewer and smaller, write smaller and many more checks. If you're investing in angel funds, look at how many underlying angel investments. If you're investing in venture funds, look at how many underlying venture investments those funds have, and split your money in a way that you have access to hundreds of underlying investments, not tens of underlying investments, which often means invest in many, many venture funds, which, by the way, is what institutions do, all the pension plans, etc. They invest in 50 or more venture funds each. And this is why you want to reduce the underlying variability. And look, if you look at this math again, the whole point of diversification is to say, You fund everything credible because you don't want to miss out on the very rare mega winners, which happen 1 in 100 or 1 in 250 times. And if this is truly the industry's distribution where everyone is trying to get it right, you do want to have hundreds of underlying investments. Some of you may have heard of 500 startups. 500 startups is just because to be statistically guaranteed that you get these 50x or more, if you make 250 investments, you may get a 50x in there. If you make 500 investments, you'll almost certainly have a 50x in there, and hence those mega winners will drive your returns. And in fact, you can run the math on this. What we did is we took this distribution and we ran it through a Monte Carlo simulation where we just took hundreds of portfolios with this percentage chance of each of these different outcomes. And when you do that, you actually find something really interesting. If you take 10 venture capital deals with this distribution here, random Monte Carlo model, you get a very good match against reality. This is the distribution of outcomes from the Cambridge Associates Global VC Fund returns. You see a very good match. And if you then say, okay, well, great, I don't want to do 10 deals, give me 150 deals. And you can do the same number with 250, with 500 deals, et cetera. But all of a sudden, with 150 deals, you get a number of interesting outcomes. The first thing that happens is if you have 150 deals, you have guaranteed second quartile results in venture. By the way, why do venture capitalists not diversify? Because they know all the institutions want to invest in first quartile funds. And if you are diversified, you are guaranteed second quartile performance. And second quartile performance is not what all the institutions look for. But if you look at this here, this second quartile performance, you also have a guaranteed and statistically guaranteed much higher median return. And that median return you get looks very interesting when compared with public markets. And this is really what people say. There's a strategy of venture which says, I'll do a small number of funds, I'll take a lot of risk, I can be top quartile, and if I'm top quartile, I will be rewarded as a fund manager, and the investors in those top quartile funds will also be rewarded. But if there's randomness to this, and there's a lot of people feel that there's a lot of randomness in this, actually top quartile means I've got a 50% chance of being in the lower half of all venture funds where my returns are miserable and can often lose money. And there's a second strategy, which is to diversify, reduce the risk, and get guaranteed good results better than public markets. When you talk about diversification, look, I've showed you the diversification for just the random results. There actually is a time element to this. I talked at the beginning about how this may be a better time to invest in venture. Valuations are down, and you can see this over time, that there are times when this market has been very highly valued, when the returns weren't that great overall for the industry. And then you can see there's been other years when the returns have been much better. If you think you can predict by time, great. If you can't, then diversify by time. And that's probably the better investment strategy. You also want to diversify by as many factors as possible. Venture capital, angel investing is no different than any other investing. The rules of good investing strategy apply, and the rules of good investing strategy say the only free lunch in venture investing, or the only free lunch in investing generally, is diversification. And you want to diversify. I mean, anyone who's got all their stocks in only one country would be laughed at by a professional money manager, because you want to be diversified by country. You'd be laughed at if you were in one sector. You want to be diversified by sector. These are all sort of good investing. You can see this is the distribution here that we have with our investments, and you can see we try to match globally. But this is, just keep this in mind. If you're investing in the asset class, it is an investment. Follow good investing strategy rules. Another thing which people don't think about is there's a lot of The private investing, private equity markets are very inefficient sometimes. And one way in which they're very inefficient is that less than 3% of venture capital dollars go to companies with a woman CEO. And that has been flat for the past decade or so. So there's a real, I mean, it looks a lot like women are underfunded, especially when you compare that with a study that BCG put out, which says every dollar invested in a female-led company gets you 250% more revenue generated than the same dollar invested in male-led companies. Now, you could hypothesize from this that women are better, but of course, if women are equal in quality to men as founders, then if women are massively underfunded, of course, those few women who are funded are the very best. And of course, they're going to have much higher returns. And you can see this massive market failing here. Now, a number of people talked about how to fix it. They said, oh, great, you just need more VC decision makers who are women. That stat right now is 16% and growing from the number of decision makers who are women. So this sort of having more women make the investing decisions hasn't seemed to affect this on a global basis. And the reason why, and I think one of the big flaws in the way our industry works generally, is there was a great study out of Harvard where they had male and female actors record a pitch, identical pitch, just voiced by different actors. And then they showed pictures of the actors. Again, same voice, they just showed pictures of who they said the person speaking was. And they asked audiences of men and women to score them as a potential investments. And they found that a good-looking man was scored a 5.21 for the same pitch that a not so good-looking man was scored a 4.59. And this not so good-looking man outperformed women who were scored between 4.14, 4.35 for an identical pitch with an identical script. So what this is saying is that audiences have an inherent bias for whatever reason towards trusting good-looking male entrepreneurs. And if you, another sort of backwards way, if you want to get rid of this bias, it's really simple. You just fund people based on the numbers. Don't listen to pitches. Fund people based on the actual metrics, and funds that fund based on actually looking at the metrics have very different outcomes. Social Capital, Clearco, and ourselves at Loyal have 30 to 40% women CEOs in the companies we fund. And it's purely because we're saying we're not going to be swayed by a good-looking guy making a very convincing pitch. We're just going to step back and look at this dispassionately, look at the numbers, and when you do that, you get very different outcomes. So yeah, just to tell you a little bit more about how we invest, and of course, we think this is like poker playing where it's unpredictable, but guess what? Even though the hands are unpredictable, professional poker players can consistently make money playing the game of poker because they really understand how to invest. I mean, bet, but invest in this area of uncertainty. And we do something very similar, which is poker players start off with a very small investment, just an ante, just to see the cards. Because if you want to be able to assess your probabilities, you need to know what you're dealing with. And we do the same. We start with a $10,000 first investment in all our companies so that we can get to know them. And then in our case, what we do every month, we pick the top couple of companies in our portfolio and we offer them some more funding. And then again, from those, we watch them pick the top couple of those, offer them more funding, very similar to how poker players will bet more money as the hands get progressively revealed over time, and they can see whether what they have seems to be a top hand or not. So we do exactly the same. 95% of our capital goes into these follow-on investments where we actually have some insight, and a small amount goes in those first checks. Now, we use very fixed rules here, identical check sizes, only picking the top couple of percent each month, even though we may want to invest in many more. And the reason why is it is well known that human beings have cognitive biases. One of the struggles with being a professional poker player is there's what your math brain tells you, and there's what your emotional brain tells you. And there are all sorts of emotional biases. There's sunk cost. Oh, I've got so much money invested already. I want to save my investment, put more money down on this hand, rather than just rationally saying, is it a good investment now? There's the endowment effect where you fall in love with an investment. You can get overconfident. People get very scared. There's this bandwagon effect. Oh my goodness, this is a great company. This is my last chance to invest in it. And each of these things are addressed in that process I just showed you. You may love all your children, but in our case, we're picking our favorite child. We can only pick the top 1 or 2% each month to get a next check. It's like picking which of your kids goes to university. I mean, it's not it's a very unfair process, but if you want to make good financial decisions, you need these constraints to overcome biases. Now, I've talked a lot here about sort of saying, hey, you can make that next investment. We make that next investment. If you're actually investing, you will often find, and there's a good quote from The Economist here, which said, the question in Silicon Valley is less what startup to back and more whether a startup lets you invest. I've seen other VCs say this, where they say, hey, judging success is easy. And I always wondered about, I mean, what do you mean judging success is easy? And then we had portfolio companies which started growing by 30% a month on average over a 3-month period. And when you see sales growing by 30% a month, month after month after month for 3 or 4 months, it gets very hard to say. I mean, it's obvious that company's succeeding, it's doing well. And then the question becomes, will they take your money? And there was a very interesting study in this, which was done by the Kaufman Foundation also, where they interviewed a whole bunch of VCs, 100 plus VCs, 100 plus founders, and they said, what matters to entrepreneurs in picking their investor? And VCs got it very right when they said, look, the number one thing, and entrepreneurs have exactly agreed, the number one thing people care about is a relationship with the entrepreneur. They also thought, okay, the number 3 thing is actually number 2 thing. What are the deal terms? What they didn't get at all is that founders want investors who can invest quickly. And investors didn't get this at all. Investors all said, oh, it's all about the brand of the VC. VC is the brand of the partner. If we build a good brand, then people will take our money. Actually, no, that was factor number 8. Founders don't care about brands. Everyone says invest in Sequoia. Sequoia will see the best entrepreneurs. No, the best entrepreneurs, they want someone they like. They want good deal terms, and Sequoia is not necessarily known for offering good deal terms, and they want someone who will move quickly. The next thing they look for after that is other founder references. Now, our fund, we have a 98% acceptance rate of our follow-on offers. I know that sounds too good to be true. We don't believe it's so good ourselves. I mean, we know the data, that's what the data is, but we struggle to believe that. But I mean, what we do in our process is we spend time to build a relationship with the entrepreneur. We offer good deal terms. We're often willing, well, I mean, our preference is to invest in common shares, which already is the best structure for the entrepreneur. Because we've been doing diligence on companies for months through that staged process, we can move very quickly. And we also source all of our entrepreneurs out of 2 networks, alumni of INSEAD, top grads of the Founder Institute, which means they can talk to other founders very easily to get a reference on us. And I mean, we have good results, but it's because we give people, the sort of entrepreneurs, the top 4 things they care about are the top 4 things that we offer them, which makes it much easier for them to accept our money. Last thing I'm going to remind you of, and this is something that many, many angels and investors in venture funds have learned the hard way. And that is that this is an illiquid asset class. You don't get your money back until there's an exit. And look, I got my top deals, you heard, I got 30 times back again in an M&A transaction. It took 14 years for that money to come back to me. And I've met many angels who say, yeah, I'd love to be doing more angel investing right now in this market. and all my money's tied up in existing investments. I can't make any more investments right now because I'm allocated I've sort of, everything's tied up. And in fact, if you invest in a venture fund, and some of you have done that already and know this very well, but if you've never invested in a venture fund before, your money is locked away for 8 to 10 years. They'll often tell you their minimum's $500,000 or $1 million. You can normally negotiate them down to $250,000 as an investment. But what they then do is they do capital calls. And the capital call is, okay, you have signed this piece of paper promising to give us $250,000. I want 100,000 right now. Keep the 150,000 in your bank account. And I'm going to come to you a year from now, 2 years from now, 3 years from now when I need the money. And if you don't give me that money within 30 days, there will be huge penalties on you. You may lose your initial 100,000, even in extremis. So there is, I mean, it isn't just that there's a large amount of money you invest, but and that money's locked up, but they actually have a call on future money that you're holding in your bank account. And it's, I mean, capital calls, I hate capital calls as an individual. It's a horrible thing. If you're a pension plan, you don't care about capital calls. You have the pension payments coming in every month, every year. You can just take that and redeploy it. But as an individual, this is a really difficult, illiquid area to invest in, and just really understand capital call timeframes and the constraints that puts on you as an investor, because it means your future money is spoken for. You no longer have control over the future money. So what did we do? We decided this is ridiculous. We do an open-ended fund. So when you look at this price we set each quarter, that price we set each quarter is a real price you can buy and sell, because Michael and I said, hey, why would we ask anything of our investors that we wouldn't want for ourselves? So by the way, for instance, we also do a 2 and 20 fee, a 2% management fee, which is common in the industry. What the industry doesn't tell you is they take 2% of money that you have sitting in your bank waiting for them to call. They still charge you a 2% management fee on that. We only charge a 2% management fee on the money you actually have invested. And everyone goes, well, how on earth can you have an open-ended fund? How can you balance buyers and sellers? And look, part of it is just being willing to be honest about your price and where you are. And all I can say is we've been running for 6 years. We have a maximum time to fill of orders of 6 months. In the first quarter, when you place your sell order, yeah, you don't always get your money. On average, you get 84%. I mean, there's some quarters when well, there's been 2 quarters so far where you might only get half your money back again when you want to sell, but is far, far better than what we see being offered out there if you're in a direct investor as an angel, or even if you're in other venture funds. So yeah, let me stop here and open it for Q&A. Just to recap, well, we talked a little bit of why be an angel, why invest in venture capital, because tech is staying private, because private is half the economy, and it might also be a good time to buy in right now. We talked about whether this is something where you can be a master of the subject. And don't get me wrong, I think you can learn a lot about venture investing. I think especially you can get very good at looking at companies you think are highly probable to fail, as long as you keep some humility. But we really look at this as something which is an unpredictable process. We've looked at the Bessemer Ventures anti-portfolio. We've seen the industry stats, and we say, well, look, maybe rather than taking big bets right away because you know you're right, if you don't know you're right with your first investment, maybe put small amounts in and see how things develop. Diversification, it's a good thing to do. AngelList data tells us it's the highest returning strategy on average to use in venture and angel investing. If you're going to diversify, remember all of the rules of proper diversification, geography, sector, economic cycle, and also think about diversifying by gender, which really means question when you're listening to a pitch, or question if you even should listen to a pitch, because you're probably pre-selecting for good-looking men rather than selecting the best business. We used a staged process, a poker type process. You can use whatever strategy you like. You can invest in venture funds, which use whatever strategy they like. But do think of investing as an access game where you want to move build a good relationship so people like you, offer good terms, and move quickly. And last, we talked a bit about the sort of the long timelines to exit. We come over that by offering an open-ended fund. Happy to talk to anyone who's interested in that. But more generally, if you're going to be in the space investing directly yourself, investing in traditional venture funds, remember that this is a very long timeline. It's sort of your money's locked away for a long time. Let me stop there and open it up for any questions you may have. I'll start with a couple of the questions I have down here. Joey tossed in here, he said he's got an obvious question, which is, what is Loyal's minimum investment? We do fixed sizes, so we start with a minimum investment first check of 10,000. The way we've got the math worked out, the next check should be 200,000. The next check should be $1 million. If we don't have capital available, because remember, we raise every quarter, so we can't always promise we have capital available. We might do a $100,000 check intending to move to 200,000. We might do a 300,000 intending to move to $1 million, but that's sort of ours. Oh, Joey's correcting. What's the minimum to invest in Loyal? Minimum investment into Loyal itself is $100,000 US. For financial investors, we do reduce that minimum if you want to join our advisor network, and we have a network of hundreds of advisors who support our portfolio companies. Any other questions that people may have? Feel free to either unmute yourself if you want to say your question, or just type in the chat, whatever is more convenient for you. I know this is a very different way of investing. Does anyone have any sort of questions about sort of, why this way of investing? Anyone want to sort of stand up and sort of ask questions about sort of the traditional ways of doing venture investing and why this may or may not make sense? Okay, we're seeing a question popping up here. I've got a question about, what have we seen in angel networks? So the big thing about angel networks, if you're looking at doing direct investing, the biggest problem you run into, and I ran into this as an angel, is it's actually, you think there's so many entrepreneurs out there looking for investment, it should be easy to get deal flow, but actually it's relatively difficult to build up regular deal flow, because if you just advertise online, I'm an angel, you get tens of entrepreneurs reaching out to you, but there's generally negative selection bias, that the entrepreneurs who reach out to a no-name angel tend to be those who weren't funded by anybody else. The advantage of an angel network is that it gives you the angel regular deal flow. There is a cost, though, is that angel networks, as a general rule, have about a 3-month cycle from the day an entrepreneur contacts them to the day they write a check. And that 3-month cycle is really slow from an entrepreneur's point of view. So it is a sort of, that is the big challenge. The thing you need to worry about in joining an angel network is that you're going to be slow money. And often the way around this, I've seen a number of angels, is join the angel network screening committee. You can see the best deal. You can get to see the deals first. And when you see a deal you like, you can often go to the entrepreneur and say, look, I know my group is going to take 3 months to do this investment. I really like you. I'd like to put some money in now. And you get a chance to invest in those top deals before they're ever available, in case they sort of get closed off by the time the angel group comes to them. Question here, what is the difference between investing in an evergreen fund and a closed-end fund? Investing in a closed-end fund is really simple, which is you give them you have a commitment of capital, like I said, $250,000. So you've got that committed. That money will get called over the next 2 to 3 years. It'll be like 100,000 called on the first close, but effectively you have to take that 250,000, you give them 100,000, put the other 150,000 in a low returning bank account where it sits there until they need it, and then you will get money back again out of the fund as the investments made by the fund exit. Some of them recycle capital, some of them give the capital back to you, but generally speaking, you won't be touching most of that money for 7, 8, 9, 10 years. In an evergreen fund, it depends on the fund, But in our case as a fund, there's just a price every quarter. It's like buying a mutual fund. It's like, okay, here's a price, and you want to sell, you sell. Now, we are a semi-liquid fund. Many evergreen funds are semi-liquid, which is you say, I want to sell $100,000 of units, and they will either say, great, you can sell the 100,000, here's your money, or they may come back and say, we can't find buyers for the full 100,000. Here are $70,000, and we'll keep the other $30,000 in units, and you can try to sell them next quarter. But that's really the big difference, is control over your money and the ability to say, you might have put your money in planning. You should always invest in venture funds planning to leave your money in for 10 years. But you can say, I put my money in planning to leave it in for 10 years, but circumstances change. Some of my other investments are down. I'm buying a new house. I want to cash something out. And having that flexibility is the big difference between an evergreen and a closed-ended fund. You're flexible control on your money. You can access it when you need to, as opposed to a closed-ended fund where you have no flexibility and you are sort of a victim of the fund's timeline rather than controlling things. There's a question here which says, how does loyal VC value startup viability? And that's actually a really good question. If you remember the quote from Abe Ottman, he said, people who invest in every credible deal are going to outperform. He didn't say people invest in every deal, people who invest in every credible deal. In terms of evaluating viability, so we have a hack we use. There's a way around this hack, which is called due diligence. So the first thing you need to worry about is there are a subset of entrepreneurs who are, there's a smaller subset who are completely lying and cheating. And there's a larger subset who are dissembling, who are emphasizing, who are hiding some things they don't want you to know, emphasizing the positive things. And the first thing you need to know is, how do I get to the truth of what's going on with the business? We hack that by only investing in companies that come to us through the Founder Institute network, where they've had 4 months of diligence by other people. We have access to that diligence through talking to the people who've been working with them for months, or we invest in INSEAD alumni. And we are very well implanted in the INSEAD network, and people have a strong disincentive to cheat someone else in the network because it hurts their network standing. So that's the first thing you need to look at. The second thing you need to look at is we use, and actually Founder Institute uses it also, we use a personality assessment, an entrepreneur personality assessment, which looks for personality traits which are correlated with business failure. So for instance, people who are sociopaths, they do wonderfully when they come into a large existing business, take them over. There's whatever stats are the percentage of top CEOs who are sociopaths, 20% or something. I forget the exact number. But if you are in a startup, sociopaths really struggle in a startup. They find it very easy to raise money, but they are horrible people to work for. And the result is they just can't build a team around them. So we look to screen out things like that. And you may have worked with someone, for instance, who doesn't like to do the work, doesn't take responsibility if it isn't done, and blames everyone else. You can do that in a large company. You can't do that in a startup. That's a recipe for failure. So we do some screening that way. We are very cautious about screening for business size, about screening for what we think the market, the interest is, et cetera, the competitive landscape, because we know that these things are unpredictable. I mean, when Bessemer Ventures passed on Google, they said, yet another search engine. How can we? They were actually the woman whose garage Google was working in was a friend of one of the Bessemer Ventures partners. And said, "You've got to meet these people. They're so amazing." And he said, "Yet another search engine. How can I get out of here without going anywhere near your garage?" So that smart judgment about thinking that you can predict how a market will evolve and which products will win, we're very cautious about doing that. There's a question here from Riaz about the data I presented assumes the entire universe of deals. How do you know that the stats apply to your more circumspect universe, i.e. Founder Institute and INSEAD? Have you looked at past performance of Founder Institute and INSEAD founded companies? Yes, we've had access to private data for Founder Institute companies, and Founder Institute has done a couple thousand companies. and the results from Founder Institute companies pretty well exactly match the distribution of the venture capital. Certainly when it comes to the big things, and the big things is percentage of failures. Those are the two stats we had, is the percentage of failures and the percentage of mega home runs. Both of those stats matched the industry average. So we know for Founder Institute it's the same. For INSEAD, I mean, there's all sorts of stats out there about how INSEAD is the #4 source of #4 business school for unicorn founders. I mean, there's more unicorn founders who are INSEAD MBAs than MIT engineers, for instance. So INSEAD has a good stat overrepresentation in outsized returns. And really, this is a business about outsized winners. So yes, we've looked at both Founder Institute and INSEAD, and we certainly find that they match the industry data. We've also found in our own subset when running it, we're tracking at slightly fewer failures than you would expect, but we've been tracking more or less to the industry stats for a number of failures. And we've also found, it's a very interesting data point, which is we found that the median INSEAD company outperforms, and by the way, Founder Institute, we only take the top 2% of companies out of Founder Institute. We found the median INSEAD company outperforms the median top 2% from Founder Institute. But the very best companies are actually relatively evenly distributed when you take into account valuation, because the INSEAD founders often have a much higher valuation for the similar progress, and we make money as multiples of money invested. So when you can invest at half the valuation in a Founder Institute company, the returns that you get back out again can be equal or better the INSEAD company because of the lower buy price. There's a question here about thoughts on venture building studios, labs, as opposed to plain vanilla VC. Look, I'll start with accelerators, and accelerators are absolutely wonderful because accelerators basically get given free money. Most accelerators, like you look at the Y Combinator plan, and Y Combinator says to the entrepreneurs, we'll give you whatever valuation you want. We'll give you $100,000 at whatever terms you want, 10 million, 20 million cap. We don't care. Uncapped note. We'll give you an uncapped note. But by the way, you have to give us 6% of your shares, which means if you run the math, their uncapped note with 6% of the shares ends up valuing the company at something like sort of $1.5, $2 million. But people don't look at that. So whenever you can persuade entrepreneurs to give you free shares, generally, I mean, that should be a good strategy. Now, the challenge is what type of entrepreneur is willing to give you free shares. So there's a little bit of that going on. I don't have enough data on venture building studios to say I'm an entrepreneur. What I know is many entrepreneurs don't like the offer from a venture building studio, which is typically, hey, run this business for us, take 25% of the shares, we'll provide money, we'll provide team, we'll provide resources, and we get 75% of the company. In principle, that's a good deal for the venture building studio. I don't know the returns from venture building studios because I don't know if there's negative selection bias on which entrepreneurs come in. So it's an interesting starting place, just like getting free money in a company, free shares in companies, an interesting starting place, but I don't have the data to see what the outcomes are. Another question here, which says thoughts on maintaining a disciplined diversification during extreme disruptions such as the recent blockchain, crypto, VR, AI. So in our case, it's really easy, which is we fund the top Founder Institute and the top INSEAD alumni, and it doesn't matter what they do. So we have been funding AI companies for the past 6 years, because guess what? There have been AI companies around for the past 6 years. We were funding healthcare companies before COVID came along, and all of a sudden COVID boomed. So in our case, because we fund the best companies within a network, we're always getting blockchain, crypto, et cetera. We had a whole bunch of crypto things when crypto was hot. then people stopped calling it crypto. They said they just said, I'm a fintech. I'm not a crypto company. I'm a fintech company, but based on crypto. Well, I mean, crypto, I mean, the distributed ledger technology or blockchain technology. So, and even right now, I mean, we've just in the process of making an offer to a crypto company in the past few weeks. And now it's sort of, I mean, you can say whether it's coming back, but in our case, we think it's really valuable to have the diversification because the world is unpredictable. And I saw it in our own portfolio. COVID came along, travel was killed, e-commerce did really well. What's happened in the past year? E-commerce is down, travel is booming again. So yeah, actually really believe in having that consistent diversification. That's the whole point of diversification, is it hedges. I mean, if you remember our returns there, you would have seen the maximum drawdown, for instance, in the venture industry. It's the US institutional venture industry is down 30%. Our maximum drawdown, the most we've ever been down, I mean, over that period when our industry was down 30%, we're down 12%. And we're down 12% because we're boring, diversified, doing everything you should be able to do within money management. Everything you should do in money management, and it really works. Diversification really works. I mean, there's all sorts of math and literature on this. And that is one of the things, that is one of the mistakes people often make when they invest in venture, is they go, okay, I'm going to invest in a venture fund. I need a specialist fund. And I need a specialist fund. There are experts in Asia in blockchain, and that's the fund I'm going for because blockchain is hot right now, and Asia is a growing market. That is fine to do when you're a pension plan who has 50 investments. You've already got diversification across sectors, across geographies. That's not a great thing to do when you've only got a couple of venture funds you're investing in. I mean, the way I think of it, and one simple thing to remember is, look, 1 in 25 deals are your home runs. The home runs are half your returns. So if you are investing in a traditional venture fund, which typically only invests in sort of 10, 15 stocks, something like that, you are buying one stock. And you will get the same returns that you get because you're buying that one home run from that portfolio. So you are taking a massive risk because it's as risky as buying one stock. And if you want to avoid it, then start counting up every 25 deals I do, I'm investing in one home run. So in our case, over 300 investments in the portfolio, you've all of a sudden got 12 home runs. That's a lot less risky. We should have 12 home runs statistically. I mean, that's a lot less risky to be buying a basket of 12 stocks than a basket of one. Question from Muhammad is actually two questions. I'll do the age bias one. He said, is there any age bias or debiasing in the industry and in Loyal? There is, people have this perception of what makes a good entrepreneur. And we all think about the high school dropout. We're thinking of the sort of the Facebook story, the Microsoft story with this a university dropout or a recent university grad. The actual stats, if you look at stats, is the best age to become an entrepreneur is I think it's between 30 and 55. Under 30, over 55, your probability of success goes down. That's just a probability. You can still succeed at either ends of those range. I mean, we have entrepreneurs as young as, in one case, we've got a 21-year-old, I think, in the portfolio. She may be 22 right now. And we also have an 82-year-old in the portfolio. So we have a very wide age distribution, which we get naturally by investing in alumni. We invest in alumni of INSEAD. And also, if you look at Founder Institute specializes in helping experienced employees who are thinking of leaving their job to start a startup. So mid-career employees who because they can do it part-time in evenings, it's often someone who has a full-time day job who does Founder Institute in the evenings to see if their business will succeed. So you see a much more even distribution from the sources we have. And that just comes back to your sourcing. I mean, wherever you source, if you source students, you will get a student age distribution. And I think there's a lot of people trying to support student entrepreneurship and forget that this sort of the 30 to 55, it is the alumni who you fund. It's not the students per se. Um, Preferred sector and geography. Yeah, I mean, although it's not a trick question, I mean, I can tell you, for instance, my partner Michael loves the pet business. So he's just like he's gaga over anything with this, which is pets. He thinks that that's a wonderful sector to be in. Um, I'm much more of a I'm much more of an analytical person who tries really hard not to name, who tries really hard to evaluate every company on its merits and tries not to sort of guess. I mean, it was pretty easy to look at travel during the depths of COVID and say, hey, travel will have a comeback. People still want to travel. But that's sort of very time specific. And honestly, I believe in diversification. Um, I think I've answered all the questions in here. Does anyone, actually, we only have 1 minute left. Is there a last question from anybody? Yes, okay, there's one question here from Mohammed. He says, in PE, there are search funds. Is there any equivalent in venture capital? Yes and no. The equivalent in venture capital, so in a search fund, you're basically going out to find a deal, go back to raise the money, and then make the investment. There are people who run sort of angel clubs, let's call it, where they go out, find a deal they want to invest in it, bring it back to all the club members and say to all the club members, who's in and who's out in this deal. So that is something I don't know what that's called. I guess you call it sort of club deals or network or venture networks or something like that. So there is that sort of thing where you can actually choose if you're in and out in the deal. The challenge, of course, is that slows down time for decisions, which means it's harder to get into the best deals because those often close very quickly. Look, it is now 12 o'clock. I should stop things here. It's 12 o'clock East Coast time. Thank you very much, everyone, for attending. Hope you've enjoyed it. And if anyone's curious about Loyal, do feel free to reach out to us. If anyone has, yeah, and let me just encourage you. Remember, big picture. You should be thinking about private equity in your portfolio. And let me encourage you to look at angel venture investing as part of how you fill out your portfolio. If we can help, reach out to us. But yeah, it's been a pleasure to be with you today. Thanks very much.